or evening wherever you are. Today's the last day of April. I'm working more on my stock market model. Uh, I work on this every day, so if you're interested, of course, subscribe to tune in the future. Like the stream if you find it interesting, that helps me out. So, before I get into things, I'm going to go over real quick. Whoa, what just happened? Where I am. So, yeah, I'm not sure what just happened. Let me make sure my screen looks good. Oh no, it started mirroring my screen. Why did that happen? Okay, just a sec. So I want it to not be mirroring. Settings. Use as. Stop mirroring. Okay. I think that should work. So, before I get into what I'm working on today, I'm going to go over the general plan for the model, what I've done so far, and then, yeah, what I'll be doing today, and then I'll get into it. So, this is the outline for the model. So, man, why does it keep doing this? Okay, back to settings. Not a mirror. Stop mirroring. So yeah, something, let me document this really quick. So something interesting's happening. I'm not exactly sure what. But let me document this and then I'll explain. Man, this is killing me. Why does it keep doing that? Man, this is gonna drive me nuts. Settings, displays, arrangement. Yeah, it's like I go to PowerPoint. Maybe PowerPoint's triggering it. Okay, so let's see if this works now. Just save this. Exit. PowerPoint. This is gonna drive me nuts. Okay, let me go through and save all my PowerPoints real quick. Okay, I'm actually gonna hide my screen real quick. And this will be quick. I just need to save everything and exit out. Maybe I can go to view. It's not on presenter view. Okay, let me try opening PowerPoint again. See if this works or makes it crash. Seems to be working. Okay. Well, sorry about such a delayed intro, but now let me go over the general overview of what I'm trying to do here. So, I have two goals. The first goal is beat the S&P 500 by a significant margin and stay market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that, 3 to 4 times better than that. And so I want to get 18 to 24% per year. Second, this should be market neutral, so it shouldn't matter if the market's crashing or spiking. The return should be the same no matter what. So I'm doing this with a long short strategy. So I have data going back to 2011. You don't want to use all data and all stocks. You want to basically isolate things that are common. Don't use all stocks because you don't want to learn the wrong patterns. Things like low volume stocks are going to be hard to scale up. So I'm avoiding stuff like that. But you want to keep enough stocks in your portfolio so that you have a lot of data to train on. So that's kind of the trade-off there. Is you have too many things, it's going to learn the wrong patterns. You're not going to be able to implement that. Not enough things, there's not enough training data. So basically the first step is isolating a universe of stocks. Once I have that, I'm using that to train a model. I've got what I think is a fairly good model working. I'll go over that in a second. And now I'm working on this final step, implementing the portfolio. So here's the model that I have and why I'm confident in it. So I'm looking at these metrics in the red box. The first one is information coefficient. That's giving me the predictive power of the model. The higher it is, the better, the more prediction capability the model has. So the stock market has a really low signal to noise ratio. It's notorious for that. So I'm shooting for an information coefficient of 0.01 to 0.02. This is kind of the standard for implementing a strategy. The next four metrics are giving me not the predictive power, but the stability of the model. So you want something that has really high predictive power, but also something that's stable. It's not extremely wrong when it's wrong. So you kind of have to weigh both of those at once. So the standard deviation of the information coefficient, I'm going for 3 to 13 times the information coefficient. This is from published studies. This is about 3 times that, so I'm good there. Information coefficient to information ratio on a daily basis should be 0.03. I'm getting 0.3, so it's larger by an order of magnitude. Similarly, on a yearly basis, I'm going for a goal of 0.3, and I'm getting 2.3. So again, larger by about an order of magnitude. In the t-statistic, I'm going for a value of 1.98. I'm getting 3.75, so almost double. So it looks really good for all of those metrics. Secondly, when we look at the decile analysis, the hallmark of a good decile analysis is one where the bottom decile is giving the lowest return, top decile is giving the highest return. And so you see this is nice, and this shows exactly that behavior, and it's monotonically increasing between, which means that each decile is higher than the previous decile. Finally, when I do a walk forward analysis on this strategy, I see that every single year it's returning above my lower threshold 0.01, and actually it's above the upper threshold every year except 2018, where it falls below 0.02, but every other year it's above 0.02. So it looks good for this reason. Also, if you look at the annual information coefficient to information ratio, that never comes close to the value of 0.3 that I'm going for. So I concluded this was a good model, but my problem was basically this. When I work on the single model that's testing from 2023 through the beginning of 26, it was really easy to get a good portfolio strategy working. However, it didn't perform well on earlier years. 2016 through the end of 2021, it was basically negative the whole time. And so this is something that you couldn't really have implemented since 2016. Nobody would sit and lose money for 5 years hoping that the model's going to turn around. And so this isn't very strong and robust. What I would like is something that's showing, strictly positive returns since 2016. The Sharpe ratio should always be high, rolling Sharpe ratio. And you see that basically is below zero, and then comes above later. And it still does really well in this region since 2023, but before that it's doing very poorly. So I needed a better strategy. The idea and the idea, there are two ideas I have here. So one is the universe became more dispersed in 2020. There were a lot more retail traders and a lot more stocks on the market in general. So it became more dispersed, certainly in 2020. The other thing is that interest rates were basically zero through the end of 2021, and beginning in 2022, interest rates went back up. So the regime changed both in dispersion and in interest rates. So I'm thinking one or both of these is the culprit. I tried training a model from 2016 to 2021. Sorry, from 2016 to mid 2018. And where did I put that? Okay, so yeah, so you see the region it's optimized in, beginning of 16 through mid 2018, it does well, but after that it does poorly. So basically something that does well on this early region does poorly on the later regions, and vice versa. So that's basically my problem that I've been having. If I look at the model, I think actually these decile analyses aren't as good as I originally thought. So the first thing is they aren't all strictly monotonically increasing. But the second thing is that the spread is often not very high between these two. So if you're going long on the top decile and short on the bottom decile, that actually won't be the best strategy. I tried, so this is with a lot of features, well over 100 features. So I tried dropping out the features that weren't necessary and just keeping the remaining features. I got these results here. So these spreads, the y-axis on these plots is a little bit higher. And they do look better. They're more monotonically increasing. And then you see here the results if I do a basic strategy on that. So here's the strategy. Here's the code for the strategy. It's returning on average over 15% per year, so that's pretty good. I'd be happy with that. And you see, basically now instead of having this being good on late periods and bad on the first period, versus being good on the first period and bad on the later periods, that's no longer a trade-off. The model basically is doing very well from 2016 through 2020. But over the course of 2020, it's basically getting killed. It goes from like 40% returns that it gained over 4 years down to zero. And then once again, you see it's taking off really since the beginning of 2022. And so now we have something that's where it's pretty easy to get a good strategy on it, except for COVID. So if we just take out the failure during the COVID regime, you see that in the drawdown here. Basically, it's the worst drawdown's about 15%. Then 2020, it draws all the way down to 30% drawdown, stays there for a while, and it's not really recovered until the beginning of 22. So now I'm trying to see, this model seems like it's doing better than where I was previously, but I need to get something that is doing well over the COVID region too. And so these are all looking good for every year. The spread's higher. The trend of the charts is better. They're closer to being all monotonically increasing. So now I'm looking at, okay, so previously I've just been training the walk forward model with 40 iterations on the validation step. Validation, it's tuning the hyperparameters of the like the learning rate and stuff of the model. So I want to see, okay, I increase that now to 100. Do I get better performance? Do the decile plots look even better? And some of them have been looking better, much higher in magnitude. more monotonic, but some of them look worse. So here's 2023. Okay, and this guy, let's move over here. So obviously 2020 looks really bad. 2022 looks bad, but actually the top and bottom deciles aren't the worst. 2023, the top decile looks bad, but it looks okay other than that. So I'm kind of trying to look around for the model. This is kind of an indicator. So I did more training on 2020. Now it looks bad. Here it didn't look so bad. That's not really that bad. 2021 it definitely looked good. Now 2021 still looks fine. 2020 looks really bad though. So the spreads though are much higher here. So here you see it's going up to 0.15. It would have killed it in 2019. Oh shoot, I forgot to... Is my screen not sharing? No, it looks like it is. Okay, good, it's back. Model 23 is the same as Model 22. Okay, this one looks really good. So this is 2024. Okay, it is easy to implement a portfolio for model 2022, which works well. Conversely, if I optimize the portfolio parameters to do well from 2016 to 2018, it performs well in this region but fails afterwards. Model 23 worked it was easy to implement a portfolio for Model 23, which made money from 2016 to 26, with the exception that it failed and lost money during COVID. The third screenshot is from redoing Model 23, but using the using 100 iterations for hyperparameter tuning. When I use 100 iterations, many of the magnitude is much higher in many of the decile analysis plots, but 2020 is clearly and significantly worse. What can I conclude from this? How do I generate a model which performs well over 2020? Okay, let's give it the screenshots. Okay, then we just need this last one. So this looks a lot better. This one looks basically very good, except for 2020 looks bad. 2022 obviously looks pretty bad, but top bottom decile are still okay. 2023 doesn't look very good. 24 looks great. 21 looks great. 16 looks good. 17 looks great. 18 looks great. 19 looks great. 19's perfect, basically. Basically need 25. So this, it's going to be hard to get a portfolio strategy on. 23 looked better here. 22, how did that look? Oh, 22 looks really good here. Let's go. We're up to trial 92. Almost done. 98, 99, 100. Okay, come on. Oh my gosh, that looks really bad too. But if we look at the information coefficient, it's basically really high every year. 0.03, well above 0.05. 2018, it's performing well now, 0.02. 2019, 0.1. 2020, though, it went negative. 2021 at 0.15 is crazy good. 22, 23, 24. Yeah. So I don't really know what to make of this. I'll put it in. So the sharp got bad in 2020 and 25, but every other year it was above 1. Oh no. I didn't save 25. Whatever. Okay, so let's think. Here is a better model with a bunch of the features dropped out. Okay, so what features did I put this at the top? I was describing the models. Model 22, same as improved Model 12. So I want to know, does Model 21 outperform 22? So Model 22. See what this says. Fantastic set of experiments, bias variance trade-off. Your screenshots and observations tell a perfect story of what happens when you manipulate features in hyperparameter tuning. Model 22 versus Model 23A. Dropping unstable features made it better. 22 had too much noise. Hey, Fat Con. here's the outline of what I'm making. So basically an automated stock market strategy. This should spit out buys and sells each day. So um, I have data going back to 2011. I'm isolating some subset of that data I'm calling a stock universe, then using that to train my model. The model should predict something like returns, probability of a positive returns, returns relative to the market, returns relative to the sector. I'm predicting the 5-day forward Sharpe ratio relative to the market. And the model looks good, but I'm trying to see right now, is there some way to improve, squeeze out some better performance? So I have a model. Now I'm trying to incorporate a portfolio model on that. So the first model I had, you can go back to the beginning of the stream if you're interested in why I'm confident. But basically, I was really confident in this model. And so I was testing this, but basically I kept having this problem, which is I could get it to work really well since 2023. 2016 to like 2022, it did really poorly. It was underwater until the end of 21. And so that's not, you can't really implement that. Nobody's going to sit and take losses for 5 years hoping that the model turns around. And so I really want something that's good from 2016 through 2026. 10 years of, it works in 10 years of back testing. I would be really confident in that. So I improved the base model by dropping out unnecessary features, and I did get this improvement here. So this is the decile analysis on the new models. Looks pretty reasonable. And when I do a portfolio strategy, you see from 2016 through the beginning of 2020, it's doing really well. But it suffers serious losses over COVID, basically wipes it out, and then, beginning of 21, it starts marching onwards. So this basically now is doing well over the whole time period, but failing during COVID. So that's a much easier problem to troubleshoot than fails early, does well later. Or I flipped it, I did the reverse, I trained it on early years, and it did well on those early years, obviously, that's what it was trained on, but then it did poorly on the later years. So I basically improved the model, and I saw that, improved the base model, the prediction model, and I saw that it's much easier to get a good portfolio strategy with this. My problem's gone from getting it to work over all regimes just to getting it to work during COVID. Rather than a stock predictor for direction, isn't it better to create a model for options which is non-directional? Yeah, that is very common. Options model is a lot more complicated though, so I'm just trying to start at like the most basic sort of strategy I can do, going long on some, going short on others. It's market neutral too. So I have two goals. My first goal is beat the S&P 500. S&P gets on average 6% per year. I want to do 3 to 4 times better than that and get on average 18 to 24% per year. With the caveat that I want to stay market neutral. I don't want to ride the ups and downs of the market. I want it to generate money no matter what. So this kind of satisfies, this is the lowest common denominator, a model trained on price features. It's kind of the lowest common denominator for implementing that. So that's why I'm focused on this. By dropping unstable features, it did better. Look closely at screenshot 3 for the year 2020. It's completely inverted. Yeah, I know. It had enough time to find that perfectly fit the 1-year validation data. Open source Gits for, that's the second goal too, is I'm putting all this code on GitHub. So the idea is make a free tool that anyone can use to train price data models for themselves. In the future, I'm going to expand it to do fundamental features as well. Okay, so the problem with macro level features I had before is that they don't. It's the same for every stock, so it's hard to find some cross sectional signal. Okay, so I have some steps to improving the model. I'm gonna go to the bathroom really quick. I'll be right back. Check this guy out. Oh, I can't see links. If you put link in the chat, I can't see it. With proper backtests, hypothesis instructions, which can be adapted to model 2.4 plus sharp. You're getting that, or some guy's getting that? Volatility vibes. Okay, good. Thanks. I'll look it up. Whoa, 43,000 followers. Anyway, I do like options. I'm going to get into it. I just feel like, this is just so much easier for... I have the data. Options data, I don't know how to get it. I got to go through the whole thing again of, making sure there's no survivorship bias, stuff like that. Test model 23, walk forward. Oh shit. That's with the 20-day sharp. So, yeah, of course that would be worse. So what was the conclusion I drew here? Okay. Thank you. Thanks for the best of luck wishes. Um, so actually, I can say let's keep end trials low. Are you using meta labeling techniques or making making trades based on predicting the Sharpe ratio? I'm not sure what meta labeling techniques refers to. The trades are basically I'm selecting the top either N% of my portfolio to use on longs and shorts, like go long on the top 10% or something like that, or just a raw number, go long on the top 10, short on the bottom 10. Something like that. And then once I have the positions, I'm using hierarchical risk parity to size the bets. So what if we change this to 3 validation years? Drop it down to 2 minimum training years. And then that'll start us in 2017. So I think what I want to try to do next is do model 22 with all parameters. So model 21, what does that give? When you train a model on the outputs of your strategy and it learns when the strat works and when it doesn't. Okay. Yeah, well, that's what I'm kind of stuck on the portfolio level model because on that actually was my initial intuition is train a model on the use the outputs of the strategy as inputs to the portfolio level, but then I decided that was too much optimization and I'm gonna have to sacrifice too much data to training. Um, oh, basically, yeah, I see. It should tell you when it works and when it doesn't. It's not even a portfolio level model. Um, no, that's a good idea. But I haven't done that at all. Okay, so here's 2016. So is the magnitude any different? 0.06 to 0.04. You can't really see a magnitude there. Minus 0.1. Yeah, so about the same. This guy's minus 0.1 to 0.06. Yeah, so about the same. This one looks better though. But that should be 2018, I think. Yeah, now it's into 2019. So is the information coefficient for 2018 was 0.046. That's pretty good. 2017, 0.03. So good. But those aren't... I've been doing fine on those years. I need 2020 to do well. Me, building it for me. My end goal is just run some code every morning. It tells me what to buy, what to sell. Oh, I need to put that in. So 2018, 2017 is actually much lower. – 2018 is higher though. – 2019 has a really low spread. Here's the moment of truth, 2020. Okay, so first step is train model 21 walk forward with sector neutral features. Hey, 2020 looks really good. Then we just need 21, 2, 3, 4, 5. Yeah, 2020 looked fine here though. Alright, train model 23, walk forward, keeping only important features from model 22, walk forward. So for 2020, oh no, was that 2019? Am I off by a year? So this should be 2020. Right? Yeah, the next is 21. So what is going on here? Fold 2 is 17. Oh. So I guess that was 2019. This is 2020. Not great. Swing trading. I'm doing swing trading. So 2021 already looked good. Okay, so I'm gonna see basically, does more validation years improve the model? Next, I'm going to look at training with the sector neutral features as well, and then dropping out the ones that aren't important. Yeah, that's and then I'm gonna try the same thing with a 20-day target instead of a 5-day target to see if that improves things. Okay, we just got another year. So here's 2022. So that's it for tonight. I'm going to keep working on this. By next stream, I'll have some update on how this has gone. But that's it for now. Thanks for watching. Have a good rest of your day. Adios.